Hi, Chris Maloof with Cross Country Financial. At the risk of sounding cliche, making the case for stocks to stage a second half rally back to the prior highs requires investors to see through some pretty heavy cloud cover. If you prefer another market cliche, it's times like these when investors need a proverbial crystal ball. We fully acknowledge how tough it is to see the bull case for stocks right now, and a retest of recent lows is certainly possible, but this week we lay out the bull case for the second half of the year. It starts with inflation. Stick around. The wall of worry is tall. Needless to say, it's been a tough year. The S&P 500 index started 2022 with its worst first 100 days since 1970. There's no shortage of bearish headlines. Some of the smartest investors out there are urging caution and calling for a recession, though Warren Buffett has been buying. The anxiety among investors is understandable given stock market losses, sky-high inflation, and rising recession risk. Consumer buying power is being eroded by sharply higher prices. The stimulus cavalry is not coming to the rescue. Wages are rising, and while good for consumer buying power, that worries the Federal Reserve. Materials and transportation costs are rising rapidly as supply chains remain snarled and China's lockdowns are ongoing. It's tough out there. Adding to the angst, the Fed's track record of fighting inflation without causing recession is not good. More often than not, its rate hiking campaigns have preceded or caused recessions, though typically at higher interest rates than we are seeing today. Nonetheless, high inflation has been a common ingredient in recession since World War II. See the 1970s, early 1980s, early 1990s, and even 2008. Simply put, the Fed is fighting an uphill battle. So it begs the question, how can we still like stocks here? We'll give you three key reasons. Bull case number one, inflation pressures will likely ease. The amount of time it takes for stocks to return to prior highs will be determined by the path of inflation. We expect perhaps 1.5 percentage points to come off core consumer prices by year end. The latest reading for the Fed's preferred inflation measure, the Core Personal Consumption Expenditures, PCE index, excluding food and energy, was 4.9%. It's fair to say a lot has to go right for that to happen, including easing supply chain disruptions, more workers entering the labor force, and a ceasefire in Ukraine. But our view is progress on these fronts over the next 7 months is more likely than not. Lower inflation tends to bring higher valuations. Bull case number two, corporate America enjoying solid earnings momentum. We just got through first quarter earnings season, and while it wasn't pretty, the S&P 500 earnings growth rate 9.3%, the percentage of companies beating earnings estimates 78%, and the change in the consensus next 12 months estimate for the S&P 500 during reporting season, positive 0.5%, were all excellent. Revenue growth exceeded 13% on a year-over-year basis as companies were able to generally pass through price increases, limiting pressure on profit margins. There were some high-profile misses, particularly among retailers, and energy certainly helped prop up the numbers, about 6 points of impact on overall S&P 500 earnings, but given the challenges of cost pressures, labor and material shortages, and supply chain disruptions, companies did an excellent job managing through a challenging environment. Solid first quarter results set corporate America up to potentially exceed our $220 per share earnings estimate for the S&P 500 in 2022, so we are officially raising our forecast to $225. Our forecast is still about $5 below the consensus estimate. Our $235 per share forecast for 2023, which is probably too low, is now more than $16 below the consensus estimate. We expect mid to high single-digit earnings growth in coming quarters to help support a stock market turnaround beginning this summer. Bull case number three, valuations are too low. Lower inflation supports higher valuations. The same can be said for interest rates. As lower interest rates increase, the value of future profits makes stocks more attractive relative to bonds. So if inflation comes down in the coming months as we expect, interest rates are likely to stay in this range. Our year-end forecast for the 10-year U.S. Treasury yield is 2.25% to 2.5%. We also believe that stocks at recent lows were pricing in perhaps as much as 50% chance of recession over the next year based on the magnitude of the stock market's decline. We see the odds of a recession in the United States during this time frame as lower than that, perhaps 1 in 3 if not lower. We expect the valuations to recapture some of the lost ground by year end as markets come around to our view that this is a growth scare and recession is not imminent. The process to get there may not be smooth for markets, especially over the next month or so, but we think it happens over the balance of the year. In the absence of recession, earnings growth plus valuation expansion can be a powerful combination. Stocks don't have to get back to prior peak valuations, nor do earnings have to reach next year's consensus levels for the index to get back into the green by year end. Our 4,800 target on the S&P 500 could potentially be reached with a 20 price per earning and a $240 in EPS in 2023, $11 below consensus, or 19 times the consensus number around $251, though we acknowledge that earnings number is probably too high. Keep in mind the index entered this year at over 21 times 2022 earnings estimates. The latest rebound off the lows has lifted the next 12 months price per earnings to over 17. Conclusion. We continue to prefer a modest overweight allocation to equities and a slight underweight to fixed income relative to an investor's targets, as appropriate, as always. Our year-end 2022 fair value target for the S&P 500 is 4,800 to 4,900, 15% above the May 27 closing price at the low end. Our continued optimism is based largely on our expectation of continued economic and earnings growth, i.e. no recession and lower inflation over the balance of 2022. If you found this information beneficial, hit that subscribe button, invest early and often, and we'll see you next week.